Hello, everyone. Yesterday's market was easy to understand. The dollar finally followed the data in logical fashion. Better than expected jobless claims, surprising strength in the Chicago Purchasing Managers Index, and an upward revision to the University of Michigan Consumer Confidence figure sent U.S. interest rates higher, Fed funds expectations up, and pushed the dollar up against most of its G10 counterparts. As long as the data continues to show a steady economy, thoughts of tapering won't be far from people's minds, and the dollar should gain, especially at the expense of the emerging market currencies. There's talk in the market that the ECB may be considering a new long-term refinancing operation aimed at improving liquidity to companies. It would lend money to banks on the condition that the money be lent on to the private sector. That would help to reverse some of the contraction in the ECB's balance sheet, which may be one factor pushing euro-dollar higher recently. However, ECB Vice President Constancio played down that idea yesterday and also tried to dampen speculation about negative rates. Denials like this would tend to push euro-dollar back up, so that may contribute to a euro-dollar positive tone today. We'll get further clarification next Thursday following the ECB meeting. That meeting will include the ECB's new forecast, which many analysts had expected to be the trigger for the rate cut that actually came at the November meeting. I'd expect to hear further dovish comments from ECB President Draghi, but given the difference in views on the board, I don't expect any further measures. The absence of any fresh initiative is likely to push euro-dollar higher ahead of that meeting, in my view. Speaking of the ECB, today we have two key indicators they'll be looking at. Germany's preliminary CPI for November is expected to rise to 1.3% year-on-year from 1.2%. An outturn like that, showing a less deflationary pressure in Europe's largest economy, could be positive for the euro. On the other hand, Eurozone M3 growth is expected to continue decelerating to 1.7% year-on-year in October from 2.1% year-on-year, bringing down the three-month average as well. That would add to the deflationary pressures in the Eurozone and hence be euro negative. It'll be interesting to see which way it works out. Now, the bigger problem for the ECB is the divergence between the money supply, which, it's slowing, but it's still growing modestly, and bank lending and private sector credit creation overall, which are shrinking. A problem like this with the monetary policy transmission mechanism really explain why the ECB might want to look at more direct ways to encourage banks to lend rather than simply lowering rates. That could be a way to solve the lending problem without causing the euro to depreciate. Of course, they may want the euro to depreciate, but that's another story. No U.S. indicators out today as the markets there are closed for the Thanksgiving holiday. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.